Welcome to week 4, Savings and Debt Management. Today we're going to be looking at saving strategies, debt management, financial boundaries. But first of all, let's recap on last week. We looked at creating your money map. We learnt careful, ongoing evaluating, reviewing, adjusting for changes, learning as we fail forward, getting better at this life game and celebrating those small wins. We also looked at allocation options. We looked at the 50-30-20 rule and the wallet or account system. We integrated our goals. Remember, our spending reveals our true financial values, meaning why our values and goals need to be aligned. So let's begin today. Importance of savings. There's 3 key reasons why we save. It's a financial safety net. Savings provide protection against unexpected expenses and emergencies. They prevent financial disasters. Now, Jamie, for example, he was not in a good financial situation. He did not have any savings behind him. He was living hand to mouth. When his car needed repairing, he found that he didn't have the funds. It ended up costing him $10,000 worth of repairs on a car that's probably worth $15,000. He was forced to have to sell his car, and that meant that he was stuck on public transport. Not really ideal for a grown man who's juggling a lot of things in life. Next, we have goal achievement. Savings essential for reaching both short-term and long-term financial goals. Dreams require funding. Jamie stopped saving, making it extremely hard to achieve his goals. Reduce stress. Having savings creates peace of mind. Money worries decrease when you have a cushion. Jamie has increased his day-to-day stress. Emergency fund. When Moz got sick, he was able to focus on health and family without financial burden because he had a wonderful emergency fund behind him for him and his family for exactly these situations. So what is it? Moz had a dedicated savings account for emergencies. It was a financial safety net. And why it matters is it protects us against emergencies, reduces stress, helps avoid debt. It creates empowerment. Where do you keep it? You choose a high-yield savings account that's easily accessible but separate from daily spending. But how much? What sort of amount do you put aside? Well, the general thought is 3 to 6 months of expenses, the standard recommendation for most people's emergency fund. 9 to 12 months for complexity, higher target for business owners or those with variable income. 100% essential costs. They are rent, mortgage, groceries, utilities, transportation. So what are the steps to build an emergency fund? Start small. High chance of probability that we'll stick with it and succeed. 2, we need to budget wisely. Realistic, doable amounts. Open a separate account. Consider high yielding, easily accessible, separate from daily spending. And automate the savings. Set and forget. No micromanaging. Just have it automatically coming out each week or month. Review and adjust. So just make sure that it's working the way you want to and that it's working for your life at that particular time because things can change. Now let's go to our workbook. You're going to look at identifying potential emergencies, assess financial stress, learn from experience. Other types of savings goals. Well, we have our SMART goals, which are specific, measurable, achievable, relevant, and time-bound. Short-term goals, they're achievable within a year. Long-term, they take more than a year to achieve. Example of a SMART goal, save $5,000 for a vacation in 12 months by setting aside $420 a month. Example of a short-term goal, purchase a $1,000 laptop by October 1st this year by saving $36 a week. Think, for example, the banks do it to you. They're going to take money from you for repayments or what have you. So why not you do it for you? You make the savings for you. Make a date for you instead of for the bank. How to save effectively? Pay yourself first. Set aside savings before there are other expenses. Make it your top financial priority. When you get on an aeroplane, they go through the whole take the oxygen mask and put it on yourself if there's a catastrophe about to happen. Save yourself get them oxygen on yourself first so that then you're in a position to help those around you. So with your finances, make sure that you're looking after yourself first, and then you're going to be much more value to yourself and to everyone else around you. Automate your savings. Set up automatic transfers to savings accounts. Consistency builds wealth. It trains you to live on less money and be more careful, more considered. It's like going to the gym. You need healthy foundations if you really want success. Budget adjustments. Reduce discretionary spending to prioritise savings. Cut unnecessary costs. Businesses cut fat to survive, so you can too. Budget when you're going to the supermarket, have coffees at home. Savings challenges. Try the 52-week challenge to make saving engaging and fun. Things like seeing how you can cut your grocery bill by 10% each week. Let's look at your workbook. Review your 1-week goals. Evaluate goal structure. Calculate savings needs. Look at money map integration. Prioritising savings. 1. An emergency fund, your top financial priority. Consider this urgent. 2. Debt, critical to address. Chip away as you work on your savings. It's a seesaw tipping effect. It's a funny thing. Sometimes people will say, I've got all of this debt. I think I should pay that off first, then start saving. No, make the debt your priority for sure, but put something in towards savings. And eventually you're going to get it to a point where it's like this, it's even. And then guess what? The debt's going to be hardly anything left and your savings will surpass and really be growing. Try it. Retirement savings, essential long-term goal. Head out of sand. It's coming. Like, everyone says, oh my gosh, Christmas is here. It's like, yeah, you had a year. We knew it was coming in a year. We've got friends who are going to restaurants 3-4 times a week, and they're not in as good a financial position as we're in, and yet they're doing that. And now the conversation is starting. I wonder when we're going to be able to retire. I don't think we'll ever be able to retire. Plan for the future. We saved, we invested. They haven't. Now they're doing what they don't want to do, and we're doing what we do want to do. So can you. Other financial goals based on personal values. Help yourself live a happier, more fulfilled life. Managing the money map to enable savings. Review expenses regularly. Gradually increase savings. Remember the successful salesman who borrowed from the receptionist? Don't be tempted to start spending more. Save instead. Make lifestyle adjustments. Take homemade lunches to work. Make home-cooked meals instead of dining out. Take progress. Learn, reward, reset as necessary. Debt management. Understanding and overcoming debt. Let's look closer at debt. Assessment. Analyse your current debt situation to create a clear picture. We need to know where we are before we can move forward. Planning. Develop a strategic approach to reduce and eliminate debt. Freedom. Experience the relief and possibilities of debt-free living. So what is debt? It can be good and it can be bad. The definition of debt is borrowed money that must be repaid. It enables purchases beyond immediate resources. Examples: a mortgage, a home purchase, student loan, education investment, automobile car loan, vehicle acquisition, credit card, general purchases. Perspective. Debt can be a tool for financial growth. Wise management prevents financial strain. So let's look at the types of debt. Got secured debt, backed by specific assets. The lender can claim asset if you default. So mortgage, home loans, if you default, they can then come and claim the house or the car. Then you've got an unsecured debt. It's not backed by assets. It's a higher risk for the lenders. It means higher interest rates. So for example, credit cards, personal loans, student loans. Good debt versus bad debt. Well, good debt is, it builds financial future. For example, mortgages, student loans, business loans. Bad debt, high interest, depreciating assets like credit cards, payday loans, luxury items. The impacts of interest rate and loan terms. Well, interest rates represent the cost of borrowing money. So we shop for the best rates. You've got loan term. As shorter terms typically have lower interest rates but higher monthly payments. So, for example, a $200,000 mortgage at 6% over 15 years costs less in total interest than over 30 years. So, the importance of managing your debt, well, you've got high interest accumulation. Interest is a fee for borrowing. High interest rates equal larger portion of repayments going towards the interest rather than the principal, which means the longer to pay off the debt. Let's look at credit score impact. When John was so stretched and defaulted on the multiple loan and credit card repayments, he tried another bank unsuccessfully. The high interest rates from less reputable means were too expensive. So, feeling very embarrassed, he lied about his situation and borrowed from family, saying it was just a temporary thing. So, the mental effects on him putting himself in that situation were huge. His self-esteem grew lower. He had increased stress living in his life, living a lie to family. He coped by overeating and he started having heart issues. So, what were the opportunity costs? Well, he missed savings. Example, $200 a month is $2,400 per annum, compound interest to that. Mixed business opportunities, reduced long-term security, retirement nest egg that could have been forming, impact on his family and friends' relationships, and there was an impact. Ultimately, and I don't want to be a downer, but John died. So let's look at credit scores and really start to understand what's going on. What is credit scoring? How is credit scoring calculated? What do the numbers mean? What is the importance of credit score? Free credit reports. Scan the barcodes to access the free reports on your page now. What does the credit score mean? Refer to the information table shown. So the importance of credit scores, well, you've got loan approval, list balances, rates, minimums. You've got interest rates. Choose the best method for you based on the situation. Insurance premiums. Allocate funds specifically for debt. Rental applications. Monitor and celebrate milestones. Your credit report and repair options. 1. Understand your report. 2. Identify errors and issues. Never assume it's correct. Just like a bank statement, you should always be checking. 3. Dispute inaccuracies. 4. Address negative terms. So, for example, John's credit card scenario has $3,000 credit card debt with 18% annual interest rate. Pays minimum of $60 monthly, 2% or $25 minimum, which is the requirement. Minimum payment, $60 monthly payment. So that's 22 years to pay off, $5,500 in interest, $8,500 total cost, $100 monthly payment, paying more aggressively. So 3 years to pay off, about $1,000 in interest, $4,000 total cost. The opportunity cost. What would John do with $4,000 saved? Well, he could have invested it for retirement. He could have built it into an emergency fund. He could have saved for a major purchase. Refer to your workbook to understand your debt. Debt management methods. Snowball and avalanche. Let's look at snowball method. List all debts. Arrange from smallest balance to largest, regardless of interest rate. Make minimum payments. Pay minimums on all debts except the smallest one. Attack smallest debt. Put all extra funds towards smallest debt until eliminated. Roll payment forward. Apply the payment amount to the next smallest debt. Continue the process. So let's look at a snowball example. Debt 1, $1,200 at 12% interest. Debt 2, $300 at 2% interest. Debt 3, $5,000 at 20% interest. Now focus on $300, 2% interest. Pay minimum on other debts. Put extra dollars towards this debt. Focus on $1,200, 12% interest. Roll previous payment into this debt. Continue minimums on larger debt. Now focus on $5,000 with 20% interest. Apply all previous payments to finish this final debt. Avalanche method. List all debts. Arrange from highest interest rate to lowest, regardless of balance. Make minimum payments. Pay minimums on all debts except the highest interest one. Attack highest interest. Put all extra funds towards the highest interest debt until eliminated. Roll payment forward. Apply the payment amount to next highest interest debt. And continue. Let's look at avalanche example. Debt 1, $1,200 at 12% interest. Debt 2, $300 at 2% interest. Debt 3, $5,000 at 20% interest. Number 1, let's focus on $5,000 at 20% interest. Apply all previous payments to finish this final debt. Number 2, focus on $1,200, 12% interest. Roll previous payment into this debt. Continue minimums on larger debt. Number 3, focus on $300, 2% interest. Pay minimums on other debts. Put extra money towards this debt. So what about debt consolidation? Single payment, multiple debts combine into one loan. Lower interest rate, could reduce overall interest costs. Fixed payment term. Clear timeline for becoming debt-free. Let's look at a comparison table. When looking at this table, it's really important to understand what feeds you best. For example, are you a low-risk person or a high-risk person? You need to consider your values, your goals. What are the benefits and considerations with debt consolidation? You need to know yourself. What motivates you? Again, what are your values? What's going on for you at the moment? What are the benefits? Simplified payments, lower interest rates, fixed repayment schedule, improved credit score, lower monthly payments. Considerations: new debt obligation, there are fees and costs, short-term focus, potentially longer repayment terms, initial credit score impact. Creating a debt repayment plan. 1. Access debt. List the balances, rates, and minimums. Number 2, set priorities. Choose the method based on your situation. Number 3, budget for repayment. Allocate funds specifically for debt. Be realistic. Number 4, track progress. Monitor and celebrate milestones. Incorporate into your money map. Number 1, set as a goal. Make debt freedom a specific financial objective. Write it down. Number 2, prioritise. Balance debt repayment against other financial needs. Create a hierarchy. Number 3, consider trade-offs. Weigh debt reduction versus emergency fund and savings goals. Number 4, review regularly. Adjust your plan as circumstances change. This is a big one. Need to stay flexible. Financial boundaries. Establishing healthy financial boundaries is essential for long-term financial well-being. These boundaries apply to your relationships with others and with your own spending habits. Reminding you in the early days, the pause button, remember, it's such a good tool for new habit forming. Also, the psychology behind paying yourself first, building your self-respect, your self-esteem. Honour yourself. Your life's a journey. Maintaining healthy financial relationships. Open communication is really important. Discuss money matters regularly. Create a safe space to share concerns. Update each other on the progress. Shared goals. You're a team, comprising 2 individuals, not one. Establish joint financial targets. Work together towards meaningful objectives. Celebrate progress together, whilst maintaining individual personal goals too. Resolving conflicts. Handle money disagreements with respect. Focus on solutions rather than blame. Listen to understand, not to respond. Remember, we've all had different upbringings, experiences, subconscious beliefs and values, remember from week 1 and 2? Navigate with compassion. Financial boundaries with family and friends. Communicate honestly. Set and maintain boundaries. Offer alternatives. Manage emotional responses. Establish personal boundaries with money. Define your limits. Be honest with yourself and stick to it. Prioritise financial goals. Think big picture and work back from there. Communicate clearly with care and compassion for them and yourself. Learn to say no. You have a plan, goals which you created for a reason. Honour yourself, be kind to yourself and protect yourself from self-sabotage. Refer to your workbook. my financial boundaries before you complete the final week's exercise. But we want to acknowledge and we want to thank you for your integrity and commitment so far. And remember, it starts with you.